Now, for more on how the bond market's reacting to the FOMC minutes, I'm joined by Joseph Balestrino. He is the head of domestic high-grade corporate bonds and a fixed income strategist at Federated Investors, and he joins us from Pittsburgh. Joe, always good to see you. I just gave our viewers a sense of how the bond market's reacting. What's your take?
Yeah, I think it's very predictable the way it's reacting, Mark. This has been a well-publicized. Interest rates have to go up to the extent that the economy starts to show any improvement. The Fed, in your previous segment, you noted it. The Fed is very optimistic, and to that end, rates should be going up.
And Joe, how important is the analysis of a Fed exit strategy going to be?
Well, I think the Fed has done a very credible, if not admirable, job of telling us precisely what they think they need to do, which is, in essence, to remove a lot of the emergency liquidity programs, allow them to expire, not the least of which is the giant mortgage purchase program, and then ultimately to raise rates. But that ultimately is a couple quarters out in our estimation.
Direct assistance to mortgage and housing markets, is that going to come to an end?
Well, it is at least temporarily.
Right.
They've been very forceful about coming to an end at the end of this quarter. And then I think you have to take a wait-and-see attitude. The reality is they don't know. They have cited housing and obviously the jobs market as the two biggest uncertainties, and they just have to see if the economy is sustainable without their help.
Joseph Balestrino, fixed income strategist, joining us from Federated Investors in Pittsburgh. Joe, before we let you go, I want to talk some more about what you were expecting. The comments generally more upbeat?
Yeah, I'd say a little more upbeat even than we were expecting. We were expecting what we saw in terms of the backing away of all the emergency programs, but they've been pretty transparent in terms of adding a final paragraph to the last couple of releases. But they're feeling pretty good about the economy at large, citing manufacturing, citing production, citing a lot of positive factors. Unfortunately, you still have that overhanging, lagging economic indicator, but nonetheless overhanging jobs market that's a little troublesome.
When's the Fed going to start tightening? Was there anything in the language today that gave you a hint of that?
I don't think so. We will get that hint. We'll get knocked over the head with that hint when the extraordinary extended language starts to disappear, at least hints at disappearing. And I think by laying out a lot of the steps in Mr. Bernanke's testimony that he has yet to give live, but he laid out a number of steps that will have to happen first before they even think about moving Fed funds. That's why I say we're looking at a late third quarter, maybe fourth quarter first move.
So you spoke of language, that extended period of time language. Is that going to be with us for a while?
I think it'll be with us for another 3 to 6 months. They will start to prepare the market, we think, 2-3 months in advance. All of that would line up to a late second quarter. If you think the Fed moves maybe late in the third quarter, they have to start to prepare the marketplace that way. And that will be the easy way to do it.
So in terms of bond market reaction to that, 10 and 30 year, can we expect them to continue to rise in yield?
I think we have to look for them to rise in yield, especially to the extent that inflation becomes a concern. In a way, in a perverted way, that would be a good problem to have. It would actually mean the economy is self-sustaining. But yeah, long rates have to go up. The key is the shape of the yield curve. The short end stuck basically at zero until we remove that language. So we could actually see we're steepest ever from 2s to 10s. We could see even more of that in the coming months.
Anything that you saw in at least a quick glimpse of the Fed minutes that gives you a sense of what policymakers may do going forward? And I mention that because I mentioned the Chris Rupke when he was here. There's always the devil in the details, and right now the main detail, the main sticking point perhaps from the Fed taking more action is that the unemployment rate is still close to 10%, although the administration touting that it did drop below 10%, it's still a little bit too close to double digits for a lot of people's comfort.
It is, and it's likely to remain very high, and arguably that drop down 0.3 was the atypical move, and you move back up as more people actually come back off the sidelines and start looking for work. In essence, that's why the unemployment rate lags and can stay very sticky for very high for a very sticky long time.
Right.
So that's the concern for the Fed. To the extent that the consumer doesn't come back in play, maybe the mortgage program has to come back in play. All of this will play out over the second quarter. It won't be a long time. They won't sit on the sidelines a long time.
All right, we're going to have to leave it there. Joseph Balestrino, Federated Investors, joining us from Pittsburgh. Joe, thanks so much. We appreciate it.
Okay, Mark, good to see you.
You too.